Stocks that pay high dividend yields can be tempting to buy, but like with most things in life, if something seems too good to be true, then it probably is. In this video, I'll explain what dividend traps are, why they're dangerous, and how you can avoid them. I'll then finish the video by sharing a real-world screen to give you an idea of what I look for when trying to identify a dividend trap. Hi everybody, my name is Michael Carbone. I'm a financial planner and a money manager in Greater Boston, and I'm here to teach you how to stack the deck and put the odds of long-term financial success in your favor. For those who aren't familiar with the concept, a dividend yield is a fraction that represents the investment return or one form of investment return to somebody who's buying a stock. A dividend yield can be solved for by taking the dividends that a stock is paying to all of the people that own that stock and then simply just dividing that by the price that you can buy the stock for in the market. So for example, if a stock pays a $2 dividend and let's say you can buy that stock for $50 in the market, the dividend yield would just be $2 divided by $50. So 4% would be the dividend yield. All right, so what is a dividend trap? A dividend trap is when an unusually high dividend yield attracts investors to buy shares of a company that may be troubled financially. And by doing so, the investor is making a decision that's uninformed. They're either overestimating the potential return of the investment or they're underestimating the risk that they may lose money. To understand a dividend trap, it's important to understand the theoretical relationship between a stock's dividend yield and the stock's risk. So generally speaking, if a stock has a high yield, then it generally implies that the stock is riskier versus a similar lower yielding stock. Now, the reason for this is because yield is a function of an investment's valuation and valuation is a function of an investment's risk. So let's consider the previous example that we used with the stock that had the 4% dividend yield. So the dividend that the stock was paying was $2 and they can buy that stock for $50 in the market. So the dividend yield was 4%. Now, if the stock's price was $100, then the dividend yield would be 2%. And if the stock price were lower, say $25, then the dividend yield would be 8%. So other things being equal, if you're comparing two stocks that pay the same dividend per share, the stock with the higher price is presumably less risky because the markets are willing to pay more for the same dividend. And I said before, other things being equal because it's not so simple in practice. There are a lot of different variables that come into play when the markets are collectively bidding up a stock to a price that they're willing to buy or sell it for. But there is generally a positive relationship between yield and risk, which is an important concept nevertheless. So when do dividend traps really become a problem? A dividend trap really becomes a problem when the investor makes their decision to buy or hold the stock based on the stock's yield alone. And that's opposed to making their decision based on the correct way of evaluating an investment's potential, which is through the lens of total return. An investment's total return would represent the true economic benefit to the investor. So as opposed to simply just looking at the dividend yields that the investor is earning from the investment, it's taking that and then combining it with any either capital gain or capital loss that the investor earned when they sold the investment. So to illustrate total return, consider a stock that pays a 4% dividend. So assume the price of that same stock drops by 10% over the course of time that the investor is holding the stock. So on one hand, the investor earned a 4% return from the dividend, but on the other, the investor lost 10% in value in the price of the stock. So the investor's total return would be positive 4% plus negative 10% or a negative 6% total return. So the investor, although they made some money from the dividend, they ultimately lost 6% on their investment from a total return perspective. Dividend traps become even more problematic when the investment is concentrated, meaning that it represents a great portion of the investor's personal wealth, or the investor doesn't have the capacity to accept the risk that's required to hold that investment, meaning that the investor may need to sell the investment to meet their near-term spending needs, or they're simply unwilling to accept the downside volatility or the potential volatility of the stock. So what are some really effective ways to avoid falling for a dividend trap? First, and the most obvious would be to diversify your portfolio. If you own a number of dividend stocks, even high yield dividend stocks, the likelihood that one of them doesn't work out and turns to be a dividend trap, it would have much less of an impact on your overall return because it would represent a smaller percentage of your portfolio. The second obvious way to avoid a dividend trap would be to look beyond the dividend. So When you do notice that a stock has an abnormally high dividend compared to, its peer companies and the, different companies in its, in its industry or its sector, just do some more due diligence, take a look at the company's underlying fundamentals. Then you can look to see where the cash is actually coming from. Companies usually pay their dividends from the profits that they're earning. So take a look at what percentage of the company's profits that they're actually taking to pay their dividend. You can do this by looking at payout ratios, which is the percentage of profits that the company is using to pay the dividend. You can compare that to the company's peers. You can look at other metrics that may, give you an idea of the company's underlying financial health. You can look at their debt levels, the revenue growth that they have, whether or not they have positive cash flow. This can be a helpful way to compare that company to, what might be expected in that industry or that sector. Based on the product that they're selling and who they're selling it to. You can consider the industry's outlook. So is the company operating in a growing or declining industry? A declining industry may put pressure on the company's ability to continue, and sustain paying that dividend. And then finally, you can research the company's history. So has the company consistently paid and increased their dividend over time, or has it cut their dividend? A history of dividend cuts is a major red flag. And it would be something that you would want to take into consideration when you're evaluating the health of that company's dividend. All right, so let's take a look at an actual group of companies to see if we can identify a potential dividend trap. And full disclosure, this video is purely for educational purposes to avoid or eliminate, the possibility that anyone might construe this as being investment advice, which it's totally not. I'm just going to blur out the names of the actual companies because I really just want you to focus on the variables that I'm looking at and how I'm thinking about them. Just so that you might, better understand my approach and then maybe you can apply that to your own process. So, all right, so let's take a look at the consumer discretionary sector of the Russell 3000 index to try and see if we can sniff out a potential dividend trap. And since every company is unique, I believe that the best way to eyeball what might be normal or bad or extreme is to compare different variables to other similar companies selling similar things to similar customers. And the reason for this is because the competitive forces that be should lead these companies to have similar revenue streams and profit margins and so on. So let's take a look at the household durables industry. And I'm going to try and compare similar sized companies within this industry to try and make them as comparable as possible. Looking at the dividend yields for each company, there are two that stick out as being high, ranging from 6 to 8-ish%. But I've already looked at the company with the 6.6% yield, and they've recently cut their dividends, so I'm going to set my focus on the company with the highest yield of 7.7% compared to the average for this group, which is 2%. And remember, with the dividend trap, we're trying to avoid buying a company that seems attractive due to its high dividend, but may be at greater risk of the company cutting the dividend, which in turn may lead buyers and sellers of the stock to collectively bid down the stock's price, leading to investment losses for you. So let's take a further look at this company. Their average payout ratio in the last 5 years has been around 50%. If you remember, a company's payout ratio is the percentage of its profits that it's allocating towards paying its dividends. Anything above 80% is generally considered to be high, and this group's average is around 26%. So on one hand, the ratio doesn't seem to be extreme, but it's certainly above what its peers are using to sustain their dividends. The risk of a high payout ratio is that it increases the odds of the company needing to borrow more money, and it takes away from the cash that's available to finance their operations and any investments that they're making in their business. Now let's move on to the company's probability of defaulting on their debt obligations over the next year. This is a statistical model, which I won't get into the details because it's really complicated, but you may be able to find this calculated for you, and if not, you can simply look to a ratings agency to see what they assign to the company for their debt rating. Anyway, the company has around a 0.35 of 1% probability of defaulting on their debt over the next 12 months, and the credit rating is a Baa2, which I don't expect you to know what that means, but it's essentially on the cusp of being demoted to a non-investment grade company. This certainly implies some uncertainty in the stock's outlook and would support the case for the stock potentially being a dividend trap. Moving on, the company's interest coverage ratio in the last 6 quarters has averaged around 3 times. This means that the company has historically been able to bring in around 3 times more from their operations compared to how much they owe in ongoing interest payments on their debt. And while this may seem like a pretty good cushion, but they still have taxes to pay, and it leaves very little room for investing in things like new buildings or even their cash reserves for paying their employee salaries and other expenses when they might have a bad quarter. So what might be a good normal number? As you can see, similar companies have interest coverage ratios well above 100 times, which is much higher than this company, so another variable to support our case for this stock being a potential dividend trap. Let's move on to this company's historical dividend growth rate. So this means each year after year, the company is increasing the amount that they're paying out to the shareholders. So this company has historically increased their dividend over the last 5 years, which is a good thing. But it also puts a lot of pressure on management, as investors will likely expect this to continue. So this is kind of a narrative sort of situation. If management can't continue this trend of increasing the stock's dividend, investors would likely punish them by bidding down the stock's price. This is another variable that probably explains why the valuation of the company may be pretty low relative to its dividend. Let's take a look towards the income side of things for this company. So this company has not been able to grow their revenue in the last 3 and 5 years on average. This is an obvious red flag, especially when they're in a position where there could be major implications for cutting their dividend. If they can't grow their revenues, it's going to be really hard to sustain this dividend, and only further supports the case for this being a potential dividend trap. And from a higher level, this is a cyclical industry, which creates even more uncertainty around the stock and its dividend. But with that being said, the company's managers, without a doubt, understand their challenges, and they're likely going to try and do everything that they possibly can to maintain value for all of the owners of the stock. But if we're thinking through an objective lens, this company is certainly at greater risk of a dividend cut or weak stock performance versus other potential options with lower yields. So in conclusion, this company may be at risk of being a potential dividend trap, and you may want to steer clear of it when you're deciding which stocks to buy or hold. All right, so in summary, dividends can offer a reliable and steady stream of income, but it's important to recognize that not all dividend stocks are created equally, so it's important to consider each investment carefully. This is especially true if you're buying individual stocks or individual companies. It's important to avoid the allure of high-yielding dividend stocks and focus on companies that have a history of a sustainable dividend payment and strong underlying financial qualities. And then finally, by doing your research and diversifying your portfolio, you can minimize your risk of falling into a dividend trap. All right, well, thank you for tuning in, and I appreciate you taking the time to sit with me and learn a little bit about dividends. I hope you got some valuable information, and as always, I've included a link in the description of this video to a link where you can book or schedule a complimentary consultation with me. We can just meet on the phone, and I'm happy to answer any questions that you might have about your investment strategy or your ability or inability to meet your financial goals. I wish you the very best of luck, and I hope to hear from you soon.